very possible to retire with covered calls as your income stream, and today I want to cover everything you need to know in order to be able to do so. Now, this video has been sparked by this one that I shared a couple of days ago, where I showed you exactly how I generated over $4,500 in profit by selling options. It sparked some questions, shall we say. So this is exactly what I shared. All of my profit from selling covered calls on one stock that I'd bought on June the 29th. And there were multiple comments like this one from Roger. You've not mentioned how much you paid back to roll your options. I'd like to know what the actual net profit is, if any. This is the net profit. This is it. You are seeing it, right? The amount that I paid to buy back and roll the options is calculated in this net credit. I put it on a sheet like this to make it easier so that you didn't have to fumble your way through math on a bought leg, a sold leg, a bought leg, a sold leg. You know what that looks like, right? So this is all net profit, i.e. the cost to buy back the contract against the premium to sell the new one, right? I'm up by over $4,500 already. I want to show you more details on this because it has sparked a lot of conversation. And this has come up a lot as well. It used to happen to me. Why does it cost me to roll out when the price is above my strike, right? This is why results like this seem very unbelievable, quite frankly, because we're used to having to roll for a net debit, right? Many times when I roll, I get a net debit. I can't make money on several stocks. I have to pay a debit to roll up and out. Is there something I'm not factoring in? When I first started with covered calls, there was a lot I wasn't factoring in. And I used to think that it didn't make sense to do things like roll. I've now changed my tune on that because I figured out what was missing. And I'm going to share all that with you today. It's not advice though. It's just what I've figured out over the years. Don't copy us strangers on the internet. But I do encourage you to do your own research and to play around with this and to not just do what you've always done because you've always done it, but try on some new strategies, some new stocks, see how they feel. Try them in a paper trading account if need be. So today let's cover the best stocks to trade covered calls on, including some of my favorites, why covered calls can end up much lower risk and higher returns than sold puts. And this part's important, how to execute and manage your positions, including when to buy your shares, when to sell your calls, rolling and exiting. And here's something I've figured out over the years as well. Letting your shares be called away is actually often the least profitable way to manage a covered call position. So we'll cover that as well. Step 1, we need the right stock. And if you found yourself rolling for a net debit in the past, you probably have the wrong stock. Having the right stock is the only way you win exceptional amounts. So what makes the right stock? It's got to be upward trending. It's got to have weekly options with volume across a range of strikes. Ideally, 50 plus implied volatility across most expiry dates. This determines something that I call rollability, which no one ever taught me. It's something that I had to figure out myself. It's got to have a range of traded strikes. And most important of all, it's got to be a company, a sector, a chart that you get that makes sense for the upward story to continue. Let me give you 2 exact examples of a right and a wrong stock, in my opinion, for this particular strategy. So upward trending, I like to just simply look at a weekly chart because it gives us a longer duration. So a friend of mine came to me at the end of last year. He didn't realize that I sold options like this. And he said that he was just starting on covered calls, and from advice that he'd, accumulated over the time, that PayPal seemed like a good option. So he bought 100 shares of PayPal to sell covered calls on. And my first thought was not PayPal. So let's look at this. Why not PayPal? It's downward trending. Now, here's the part that people also don't talk about is what happens on the other side of the trade. The person buying the call is making a short-term bet that the stock will go up. That's how they're making their money. Now, on a downward trending chart like this, people aren't rushing out to buy high premium calls to bet that the stock's going up because there's not a great reason for it to go up, right? So always keep that front of mind. Is there a reason for someone to buy a call on this? Because if there's not, then we don't want to be selling the things that we don't believe people would want to buy. The other thing is if we look at the options chain, I just look at the very next expiry. First, IV is quite low. Second, we can only get money on, realistically, 3 strikes. Selling a call for 9 cents on a $60 stock is not worth it, right? So there is not space. There are not tradable contracts across multiple strikes. Let's look at what percentage that is, right? So from 59 to 62, look at the move that would get us. 59 to 62. This is it. We'd be getting barely a 5% move to get a teeny tiny amount of premium. In my views, look at the size candle that would print, right? That would print a teeny tiny candle compared to other candles that it usually trades. So not a good stock. The example that I have been sharing is Credo. Now, Credo is in a very upward trending stock. It makes sense that people would want to buy a call to bet on the upside of this, right? Where else can we see that? In the options chain. If we come to the options chain and we look at the same expiry, August 14, firstly, we can see that we've got nice high IV, call it 90%, but look at the range of strikes that we can trade. We can go all the way up to, let's call it 300, and still get about $100 worth of premium, right? So we're trading at the moment at 250, 300 gives us a 20% move. And look at the size of that candle compared to the size of some of the others. So there is room for us to sell these calls. That's important, right? Let's come back and keep working through what some other good stocks might be. Okay, so we've just covered this part, choosing the right stock. These are some of my favorites that I like to trade. Now, I've put an asterisk against NVIDIA and TSM. You'll see why as we start going through this in more detail, but basically they're okay, right? You'll probably find that you can't get a great credit to roll. There's a few different things going against these stocks, but they're okay. I do in fact trade calls on NVIDIA, but nowhere near as profitable as what you've seen on Credo. Far from it, right? Apple and Google, terrible. Terrible. Poor ROI, less flexibility, less premium, which ultimately, even though it's a stock like Apple and Google, if your reason for trading is income, is premium, is return, you want good ROI, right? So what makes a good covered call stock? This is the number one factor that determines if a stock will be a great candidate for covered calls. No one talked about it. I had to figure this out on my own by trial and error, right? I'll show you how to figure it out, but I call it rollability. This is what gives you not just the money, but the flexibility. And once you've got all of the rules that I just went through, figuring out the rollability becomes the next part, right? So we'll cover that shortly. Start your position, buy the shares. Don't try getting assigned on a sold put. Buy the shares right away so that you can get the most premium on your covered call immediately. Why can you get the most? Because you're selling the call at the same, when you're trading at the same price that you bought the shares, right? You don't have to go as far out of the money to get a profit if your shares are called away. Whereas if you've been assigned on a sold put, chances are you're having to sell quite far out of the money in order to make sure that you're not selling below your cost basis, right? So buy the shares right away. Let me come back to the charts and show you exactly how I would start a new position on Credo if I was doing it today. Now, first up, you need to determine what your entry price will be. I actually don't mind Credo at this price, 250. Why? Because we've broken out on the weekly chart, we've broken out of this short-term downtrend quite convincingly. The stochastic RSI is starting to turn, and we've potentially got to move from where we are at least all the way back to these all-time highs, call it 300. So if I was buying the shares at 250, the first thing that I want to do is lock in a good amount of premium on my very first trade. So coming to the options chain, and here's something else that I don't consider is delta. I'm not looking at the delta because I don't care. What I care about is the amount of money that I collect, right? So if I'm going for if I'm buying these shares at 250, I might decide, you know what? I'm happy to get, call it, between 770 and 840, let's call it 800. I'm happy to get $800 premium as my very first money in the bank, and that would give me a $260 strike price. So I'd still have $1,000 odd in that move should it happen. So this might be the very first contract that I choose. Now you can see here, if I'd been assigned these shares and I was underwater, to get my $1,000, I might not be able to sell at 260. Well, I wouldn't be able to sell at 260. I'd probably have to sell at 270 or maybe 280. So I'm getting far less premium on that very first sell. And I want the most that I can possibly get on that first sell, balanced between how much capital appreciation I want based on where I think the stock will move in the coming week, right? Let's continue through how we're now going to manage this position. Okay, so like we said, our goal is to get as much premium upfront because that reduces our risk. And also we want to be able to lock in a little bit of price appreciation should the stock go our way. Now, this part I didn't mention just before. Only sell 1 week out because that maintains control over the trade. We don't have to sell at as high a strike if we're only going a week out. This will all make much more sense once we start talking about rollability and you start to see how having that contract closer in time works in your favor. So we've sold that first contract. What will happen upon expiry? Only one or two things, right? We'll be trading below your strike, in which case you can sell next week's call at your purchase price. I say purchase price for now. I've got an entire video on selling below your purchase price, but this selling below your purchase price can only happen if you have the right stock and a rollable stock, right? If they're trading above your strike, you can either let them be called away, you can buy back the call and sell the shares, or you can roll them. Now, how do we decide what to do? Because most people just either let them get called away or try to roll way back up to what it's trading for. And I usually don't like either of those options. So how I come up with what the next decision is, I use math, not emotion, right? I think this has served me very well in my trading. Math, not emotion. So let's do our first little bit of math, right? On if we buy back our sold call and sell the shares. Now, if the stock had a huge run up and it's well above your strike, oftentimes letting the shares get called away is the least amount of profit that you can make. Just think about that for a moment. Letting your shares get called away, if you've well and truly blown past your strike, will often be the least amount of profit you can make. And here's why. Your shares move at 1 to 1. $1 up, your shares go up $1. $2 up, your shares go up $2. But your sold call does not, because your sold call has a delta of 0.3, 0.5, 0.6, 0.7, but not 1. So what it actually means is that if you get a $20 stock price move, your shares will go up $20. But maybe that call goes down, or technically up, but a loss for you by $15. Your call's negative 15, your shares are positive 20. You've got in there an additional $5 per share profit that you've just let go if you let the call away happen, right? let's continue to work the math through on this. Let's say that we've got a potential share sale price of $110, right? That's where the shares are trading at expiry. If we take your purchase price off of $100, you've got $10 profit per share sitting there, right? Your sold call price originally, let's say you received $1 for your sold call. But now, because the stock has gone up so much, it'd cost you $7.50 to buy that back. So you would be in a loss of negative $6.50 per share. But your profit per share, if you do this, buy back the call, sell the shares, would be $10 minus your $6.50, $3.50 per share. Let's work out the other side. Let's say that that call that you sold was at a strike of $101, right? You bought the shares for $100, you can sell them at $101, so that's $100 worth of profit. The covered call premium you received was $1, so $100. So you've got $200 worth of profit if you let the stock get called away. You've got $350 profit if you buy back the call and sell the shares. Now, this doesn't always work out this way. It's why you have to do the math. But I don't know about you, I think that it's worthwhile doing a sum like this to see which is going to get me the most profit. Usually, the further the stock is run, the more profit you can make by doing this, right? If you don't want to do this math, stick it in ChatGPT and ask the questions. Do what gives you more profit. Now, what about rolling? Rolling, again, is something that I don't think enough people do math on. I didn't, right? And I also didn't even know this. So when I'm looking at do I roll or not, I'm asking what's my annual and your monthly ROI goal? You should know that number. If you don't know that number, come up with that number, right? If, assuming I still want to keep the shares, if rolling up and out 1, maybe 2 weeks at the most, gives you enough additional premium and capital gains that it exceeds your ROI goal, do that. I do that. Now, something else when it comes to rolling, staying in the same trade is often less risky than selling out and opening a new position, because oftentimes you're having to get back in at a higher price. So consider this as well. I'm not saying one's right, one's wrong for you, but I'm giving you things to consider. So the sums on this position that I've got, right, on my Credo position, my total investment is $24,500. The annual return that I target is at least 40%. Why 40%? Because that beats the Qs, taking into account tax. I've done an entire video on that. If you're interested, it's the wealth wheel, check it out. So how do I work out that? 24,500 times 40% divided by 52 weeks per year. That would give me $188, right? So a return of $188 per week would hit my goal of 40%. Let's bring this into action. All of these rolls, if I've received above $188 credit, I've exceeded my 40% annualized ROI, right? My annualized ROI at the moment for this trade, not taking into account that the shares are yet to be sold, just covered call premium, is over 412%. I've held the position for 39 days so far. And this is, remember, this is the net credit. The cost to buy back the contract versus the premium to sell the new one. This is all net credit that is sitting and landing in my account. If I get called away on 8/14 at $250, this premium is all mine. This is the profit. This takes into account the buying back and the selling of the new contracts. I cannot say that enough, right? So if I'm achieving more than my annualized ROI, to me it makes sense to stay in the position if I think there is still upwards movement, Now, rules for rolling. You don't have to roll back to out of the money, just up. You just go up a little, or even the same strike, right? If we're trading at, so my strike at the moment is 250, and right now we are right at 250. If during next week I want to sell at the 250 again, because maybe we're at 255, for example, I can do that. I don't have to go up, right? And definitely, if at the end of next week we're maybe trading at 300, I definitely don't have to try to get to 300. I can roll for a little bit, only ever for credit though, right? Because remember, we don't want to roll for net debit. Net debit doesn't make sense. If you find that you want to roll for a net debit, come back and do the math on buying back the contract and selling for where you are, because I guarantee that that's going to be better than getting a net debit to roll to an amount in the future that you may or may not ever hit, right? So, what does this bring us to? Either, if that's happening, you're in the wrong stock, you're rolling too late, your contracts are too far in the future, or you're trying to roll too high. But above all, it means your stock is not rollable. So now's the fun part. Let's come into some options contracts and let's figure out if your stock is or isn't rollable. And this is where you'll see why Apple is a terrible candidate for this. You'll see why you need to roll quickly. You'll see why you need to keep the contracts tight in date. And also you'll see why high volatility works in your favor. So I like to use bar chart for this. I find it very easy. Firstly, just search for your ticker, bring up the options chain. I'm going to start by showing you why Apple is terrible, right? Expiration that I'm going to choose at the moment is next Fridays, so 8/14. And let's pretend our strike has just gone in the money and we want to roll. So let's use, for example, the 310. So what am I looking for here? Let's say that I've sold the 310. I want to buy it back and roll it. So 310 to buy that back will cost me $588. To roll it out 1 week into the future and get a credit, I need to sell something for more than $588. So let's come out another week, which would be 8/21, and I'm looking for as high as I can get for $588. And I could get to this $312.50. Not much, right? I at the moment can sell that for $630 minus my $588. So I could roll up for a net credit of $42, but I'm only going to be able to get $2.50 on my strike, right? I could go out further into the future, yes, but remember, I like to keep my strikes close or my dates close. I could go another week and I could get $655, right? But that's only another, what's that, $25. So it's not easy to roll it. And this is why you're likely being stuck with net debits, because you want to roll further than $2.50. The other thing, so what we just looked at there was trying to roll when you've only just had your strike breached. But what happens with a lot of people is they will wait until their strike is so far in the money and then they try to roll, and this creates a whole new world of problems. So we're back at 8/14. Let's pretend that we've gone so far in the money, maybe we originally sold this 280. So to buy back the 280, that's going to cost us $32.06. Now we need to see into the future how high we can roll and still get at least $32.06. So let's go out another week, 8/21. We're looking for 32.06. Look at that. I can't. The next strike up from 280 is 285, and I'm only going to get $29. So I'm not at a net credit yet. Let's go out another week. Nope, still only 29. I'm still not at a net credit, and I can't even go up one strike. Let's go out till September. Let's go end of September even. Let's see if we can get end of September. 280. 33. So I would have to go all the way out to a 48 DTE. I can roll up by one strike, and I'm barely getting a credit to do that. It's costing me 32.06 to buy back the contract, and I'm only getting 33.91 to sell this one. I'm only getting $1.85 for it, and I'm only able to move my strike by $5. Apple is terrible if you plan on gaining more as the stock appreciates. I absolutely never, ever, ever would sell a covered call below acquisition price on a stock like Apple, knowing that I can't roll it. This is not a rollable stock. Let me show you Credo. Worlds apart, and this is why I can roll Credo so well and continue to get these credits when everyone thinks that I'm crazy. So 814. Let's use the same example. We've just gone in the money, so 245. If I'm buying back that contract, it's going to cost me $14.38. If I want to roll that out a week, so out to 821, I'm looking for something above 14.38. So 15.10, I can roll up to 255. I can go out, buy a full $10 in strike, and I would be receiving 15.10, whoops, minus my 14.38 that I would buy back the other one. That would be an additional $72 credit for a 1 week roll, rolling up in strike by $10, right? Now, when do you roll? For me, as soon as my strike is breached, because we just saw what happens if you wait longer. The further in the money, the harder the roll becomes, right? The reason why I keep my contract dates close as well is because if I wanted to go out 2 weeks, I could get even higher. I could get almost another $10, but definitely I could get $15 worth of additional capital appreciation. And so that would be 1822 minus my 1438 to buy back the other one. That would be almost a $400 credit, a $384 credit by rolling out 2 weeks and up by $15 in strike. Now, if I'd already sold, let's go with the 30-ish DTE, 34 DTE, right? Don't mind my cat. If this is the contract I'd sold and I wanted to roll it, let's use the same, let's go 240, right? If I was at 240 and 35.85, and I wanted to roll that one out, I can still get the extra $10 worth of additional movement here, but now to realize this, right, if we've breached my strike really quickly, to realize this additional $10 worth of capital appreciation, I have to wait 41 days versus if I'm rolling a week in time, at the most 2 weeks. That's it, right? This is what makes a stock rollable. This is what brings the entire process together. Do this for everything you're selling covered calls on. Don't go into a covered call without knowing where you can roll it to. To me, this is like risk management 101. This is knowing your exit, especially if you ever intend to sell something below your purchase price, know where you could roll to, what date you would have to roll to before you enter. Because otherwise you'll find yourself in a position like with Apple, for example, where we just can't roll the thing. But if we looked at this first and we thought that we might have to roll it, we would never have entered the trade. So in summary, choose the right stock. It's got to be in an uptrend. You want an IV of over 50. That's what helps it become rollable. Weekly options with plenty of open interest, and check that it's rollable first. Now, I do have a caution. Before we get into the caution and wrap this up though, if you're not yet a member of the 50K Club and you like what we've discussed here today and want to learn a bit more, 50K Club is the place for options traders to create a consistent monthly income without the need for a big 7-figure account. If you're interested in that, the link is in the description. Come check it out and join us. So far from my $50,000 account, and I share all of the trades I take within this account, in May, it's achieved a return of just under 5,000. The months of June and July, over 3,000. So there's a nice return there, and I share it all with you. So my word of caution. I'm sure there's a lot of people who are now going to come and say, but volatile stocks are risky. And I just want to ask you this question. Are they? Because PayPal has low IV. And I would much rather have had my money in a volatile stock with high IV that met the criteria that we just discussed versus PayPal for the last 12 months. So what I want to just leave you with is that downtrending stocks with no reason to change direction are risky. Stocks that you don't understand the fundamentals of are risky. Stocks that don't have institutional investment piling in are risky. Stocks without increasing earnings, guidance, sentiment are risky. Stocks with high IV in and of itself are not risky. I hope that's given you something to think about. So that is it for this video. I hope that this has given some more clarity to why I'm able to get the returns that I can get on my covered call positions. I hope it's given you a bit of an insight as to why you maybe are having to trade or roll, should I say, for debit, or why you can't roll, and that you've now got some different stocks to consider in your arsenal so that when you're going into covered call trades, you know what you're looking for before you enter. All right, see you in the next video.